Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everyone. It's Tuesday, July 6th. Hope everyone had a great 4th of July holiday. I know I enjoyed a couple of days off and always appreciate that. Friday afternoon, we had some of our staff over. That's always nice to have a social get together. So that was great. We had lots of desserts. My mother-in-law, who works with us, God bless her, because she is, I'm not going to say her age out loud, but she's working. She really enjoys coming in and helping us. She does a great job for us, but she makes the best cakes. And we ended up having 3 for just a few of us. So it was an enjoyable celebration that way. So I hope you all had a really nice holiday and you got take some time off. Today I'm going to go over, as I always do, market updates for you. I've got some analyst reports that I've gone through and I thought you might find interesting. And then I'm going to talk about a financial planning concept that should be really that all of you should know about. But as I said before, it's always good to review. And I'm going to talk about your investment buckets. So where your investments sit in the taxable, tax deferred, and tax free or tax advantage buckets, and the importance of those, and how to identify how much funds should be in each. And of course, it's very individualized. Clients of mine know that, but it's always good to review these things. So we're going to talk about the buckets. We're going to talk about the market. So stay with me. It looks like most of you are here. Our registrations grow every week, and I really appreciate that. We just upped our subscription on Zoom. It's now allows for 500 of you to join us. So on a webinar, but I don't know if we'll have that on a regular basis, but wouldn't that be neat? So let's get started. Next week, there will be no webinar, no Tuesday webinar. I'm on vacation next week, and I'm going to try not to work during that time. So although my son is flying in and we have some digital marketing work to do together, so we'll spend some time working on that. But no webinar next Tuesday, so we all get the day off for that. I want to remind you that you're of course being recorded. You are muted. The Q&A is an option at the bottom of the screen there. Your chat is, however, disabled. We did return to the office a couple weeks ago. The staff came in and we started scheduling in-office appointments just on Wednesdays to start. So we'll expand that as we need to. However, as you've heard me say, we're working on our renovations. I was delivered on Saturday, I think it was Saturday, my new plans from the architect. So now the next step is to file permits and get everybody working. So I'm hoping that starts in August, early August. So we might be right back out of the farm and back into our remote locations in August. But for right now, we're having in-office visits if you need them on Wednesdays only. We've finished a couple special webinars. So on June 9th, we had using annuities and retirement planning and wealth conversions. That's been released in recordings to everybody. We also, on June 30th, so just last week, we did fiduciary assistance for powers of attorney, trustees, and executors. I expect that recording to be available in the next week or so. Investment fundamentals is coming up on the 21st of July, and then the reality of the 4% rule. So as I said, today we're going to talk about what are in your buckets, or what are your buckets, and how they work in financial planning and striving to be tax efficient or tax free. There were a couple really good slot updates that I wanted to share with you. So as you all know, I'm part of Ed Slott's Master Lead Advisor Group. There's only a few hundred of us in the entire country, and that always astounds me. But we get great support and information from ed and education. In fact, I have to take my exam from our last meeting, which was another virtual meeting. Hopefully that's the last one. But we had a virtual meeting a month or so ago, and I have to take the exam for it. It's due by this Friday. It's serious stuff. You can't just kind of plod your way through or fake it through. There's a lot of legal updates and tax law information, and I'm not a lawyer, right? But these are things that we have to pay attention to when we're doing these plannings. So there are mailbags that were sent out, letters that come in that we receive throughout the weeks or throughout the week from one week to another when I see you. And I like to pick out ones that I think are interesting and you might appreciate it. So here's one, and both of these I think are from Andy. No. The first one's from Andy Ives. So Ed has, when I say Andy, Sarah, Ian, they're all the ones I can think of off the top, and of course Ed. This is his team of experts, and they help field questions for us, research issues for us, but they also answer questions online from others. So this question came into Andy, or he answered it. And the question is, I would appreciate your views on the following scenario. IRA owners over the age of 72, let me go back. An IRA owner over the age of 72 has children who are not good with money. Owner anticipates dying in the next few years, that's said. If his kids are the beneficiaries of his estate, and if he names his estate as beneficiary of his IRA, then will the executor of his estate be able to disperse the IRA over the remaining lifetime of the deceased? It's getting complex, thus controlling the distribution of his IRA to the children. So let me explain to you what they're asking. For whatever reason, this IRA owner feels though he or she only has a couple years to live. This is from a financial advisor or financial planner who is asking this question. We get these all the time into the Slack group. Folks who don't do the education, aren't in the program, and aren't part of the Master Elite or Elite Advisor program, and write in with these questions. So some from time to time they're answered. I think there's usually a fee for that answer, or there should be anyway. So in this case, the planner is asking. This person is thinking he or she's going to pass in the next couple of years. They're concerned that leaving this IRA money to their kids, it's not going to be spent well. So could they leave the beneficiary to the estate, therefore have some kind of control over the distribution of the assets using required minimum distributions? So we get questions. I've had questions like this from folks. People try to think of, interesting ways to control distribution to their children or grandchildren. It's often not all of their kids or grandkids, or there might be one or two that they're concerned about, but this is not uncommon. So that's the situation. They go on to write, I realize it will eventually run out, but the IRA owner may appreciate that his kids will not have immediate access to all the IRAs. So they write back. So again, they're trying to control the distribution of the IRA through required minimum distributions through a kind of a stretch situation by leaving it to the estate, by distributing it over the remaining lifetime of the deceased. So Andy writes back, while this plan could work, it has the potential to fall apart. Yes, an estate as a non-designated beneficiary, and since the IRA owner is over the age of 72, would require RMDs to be paid out of the estate from the estate-owned inherited IRA. The estate would then send out the RMD to the beneficiaries of the estate. Here's the issue. However, an RMD, required minimum distribution, is just that, a minimum payment. A person could always take more. So what Andy is saying is that although you're saying that there's a minimum amount that's distributed, doesn't mean that the beneficiary couldn't take the entire amount or petition to take the entire amount. A person could always take more. The plan would require a strong and independent executor of the estate to rigidly adhere to the annual RMD required minimum distribution schedule. To further complicate things, unhappy beneficiaries eager to get higher payouts could even mount legal challenges. Such a plan would also require the estate to stay open, adding additional expenses for a number of years. A trust would probably be a better option. Trust can be specifically designed to prevent spendthrift children from burning through accounts. The trustee of the trust could be allowed to distribute any amount annually or none at all. This could continue into perpetuity. Not really into perpetuity, but I understand what he's saying. Granted, the IRA would need to be emptied within 10 years based on the Secure Act guidelines, and anything remaining in the trust after that time would get hit with the high trust tax rates. Nevertheless, with a trust, you could extend the father's hold on the assets beyond the 10-year period and beyond his single life expectancy. So what Andy is correctly saying is there's a lot of potential for issues if you're putting all this on the executor. So if it's a professional executor, an attorney, let's just say, he or she may be able to be rigid enough to just distribute the required minimum distributions, but there could be a lawsuit. So a beneficiary could say, I'm the beneficiary of this IRA. I have the ability to get all that money, and then father and mother's plans were kind of dashed on the rocks. What if it's a family member who's getting all that pressure to give those additional assets? Handling estates is difficult enough for families. I think that's a difficult position to put somebody in. But Andy correctly identifies a trust as a potential issue. So that's a bit complex, but I think is a really good look at some of the benefits and drawbacks when you're looking at trying to design distribution from an IRA after death. And then one more, and then I promise I'll move on. So this was a once per year rule. We get a lot of questions about this from people about rolling over an IRA. There's a relatively new rule. It goes back just a few years that you could only do a traditional type of rollover. Now, what do I mean? I mean the 60-day rollover where you get the check yourself, it's in your name, and then you have 60 days to decide what to do with it. Used to be kind of a game that people would play where they'd get the check, they'd roll over, they put back half of it within that 60 days, and then another half, or half within 10 days, and then another half within 10 days. But that's problematic today because the courts have said you can only do this one time. The IRS, I guess, came out, maybe the IRS courts came out and said you can only do this one time in a 12-month period. So the question that came in is, I rolled over an IRA in March 2021 from a TD Ameritrade institutional account to a TD Ameritrade retail account. I currently would like to do a 60-day short-term rollover. Would this not be allowed because of the one rollover per 12-month period, or is a 60-day short-term rollover treated differently? Thank you for your time. I think you can probably all guess what the answer is here. And the answer is any traditional IRA to traditional IRA rollover or Roth IRA to Roth IRA rollover is subject to the once per year rollover rule. That would include a short-term rollover. There's no exception for any short-term rollover. So if you receive another IRA distribution within 12 months of your receipt of the TD Ameritrade institutional account, you can't do a tax-free rollover, even a short-term. He keeps referring to short-term, and this is from Ian Berger, to give Ian credit. He's an attorney with the Slack group. There's no such thing as a short-term rollover of the second distribution. So you've got it, and that 12-month period is 12 calendar months. It's not like, well, here I just did a rollover in December 2021. I get to do another one in January 2022. It doesn't work that way. All right. Let me just see if there's any questions. I'm not seeing any questions. Okay. Let's give you some market updates. So the year continues to be strong. So far this year, the S&P 500 is up 16.73%. Just in the past week, right? So this ends Friday, the 2nd, 1.71%. For the month, it's 3.55. The Dow Jones was down a bit. Oh, no, it wasn't. The mid-cap index was down a bit last week, so half a point. The small caps were also down last week. That's 1.32. But overall, everything's doing pretty well. The treasuries are bouncing a little bit. So overall, we're really having a great year. So anytime you're in the teens, 16%, you can't complain about that at all. And coming out of this, this recession and the global pandemic, everything's recovered very, very strongly. The S&P 500 still 12 months. So July 2nd last year to July 2nd this year, excuse me, is 41.21% up. So if you didn't panic and put all your money in cash and stayed invested, you did a good thing. Now, listen, there was nothing wrong with holding some funds in cash during that. And we did that for many folks. But if you need that cash, it's better to have it available and give up some return than have significant losses. I haven't talked about BlackRock for a while. I liked the report that BlackRock did over the past week, and it gives a view of what their portfolio managers are talking about. So I'll just read this to you. It says, this week, portfolio managers discuss possible challenges to their risk-on stance over the next 6 months. So that's invested in the stock markets and taking risk in their investments instead of holding things in short-term bonds or cash. 4 in 10, so 4 out of 10 of their portfolio managers are most concerned about central bank tapering, rate increases, or miscommunication, while others express concerns about serious inflation overheating, vaccine-resistant strains of COVID-19, and increasingly frothy markets. What does a frothy market mean? Well, we've got about 16% growth over this year, about 44% year over year. That's a pretty heavy return for coming out of a global recession and a global pandemic. So that's the froth. And I have a chart here that I'll share with you that I like these charts. There's discussion about the Fed, and there's a risk that the inflation ends up surprising the Fed in the markets, though we'll likely need to wait until the reopening is complete to settle the inflation debate. So what's the inflation debate? Many people think that the inflation is here to stay for a little while. Personally, I believe that we're going to be fighting inflation for some time. Many people believe that it's a short-term pop because of people coming back into the economy and spending money. And you're going to see certain inflationary issues that are going to respond to that, but some will probably be more long-term. The market will likely experience growing pains with the Fed's new reaction function. So BlackRock is saying, this is the portfolio manager on the global allocation team. They're saying that the Fed is becoming much more reactionary to the markets. And really, you can see that because every time they talk about raising rates or normalizing rates, because rates are still really low, we see a big drop in the market, the stock markets. And that makes everybody very, very anxious. So the question is, how long can they keep rates this low? Every time you think they're going lower, they can't go any lower, they do. A portfolio manager, let's see here. Let's see. They're really the highlights of that. There's a lot of other little. They talk about the Delta variant. They don't think someone doesn't think there's a wholesale change needed in portfolios, but notes the growing sensitivity of a number of asset classes to rate volatility, which they're talking about hedges. But let me explain this. I'm going to share my notes with you in a second. Let me just make this a little bit larger. Oh, that's not what I wanted. That was not the keystroke I wanted. So I'll do it the old-fashioned way. Okay. So this is what they're talking about frothy markets. So I'm just going to share my notes a little bit with you here. I'm going to share my screen. All right, you should see a chart in front of you, and this is directly from the BlackRock's report here. So just raise your hand if you see something that's green to the right and red here. Thank you very much. So this just shows you. So it's just a breakdown of where things are. And this is, I think, the first, this is the first half of the year. Actually, stand by. That might just be the second quarter. Let me just check that for us. I should have written that down. Let's just see. Quarter to date. Okay, so that is the second quarter of the year, and this is where, per the BlackRock's chart here, piece. So this shows where things are, and this is what they're talking about, the frothy market. So you see Brent crude oil, so that's up significantly. I'm sorry, I cut off the number there. That's at 18.5, so that would read 18.5 right here. And then commodities at 15.4, 13.7. The NASDAQ's up 9.5, the S&P 500 8.5 just for the quarter. That should have given us the information we needed right there. But you'll see this is a froth that they're talking about. These are pretty frothy markets. There's a lot going on in a short period of time. Not a lot on the negative side here. So this is the concern as things really get, build up. How long can it stay that way? So it certainly demands a conversation. So let me stop sharing that. I like that chart. I hope it was helpful to you. All right, we're going to move on to our financial planning discussion, and I'm going to switch to my whiteboard here. So let me just commentate on some of the things I talked about just then. So there's always a lot of discussion about what we should be doing: overweighting, underweighting, risk on, risk off. BlackRock, for example, they have some of the best analysts out there, as many other companies do. I mean, these are all really high qualified, very, very smart people. And a lot of times they get it wrong. So they're hoping that the majority of their bets are better than the ones that fail, right? So they do a better, they have winners more than losers, of course. Not that they're always going to have the right answers. But the idea is, I believe, you don't count, you pay attention to these things. You may want to, but we certainly do. You pay attention to the information we're getting from these independent analysts. It's important. I don't work for BlackRock, for Riverfront, for any of these, Invesco, any of these people that we get the information from. So it's good to have these independent analyses and make our decisions, our investment decisions. But our investment decisions are based on strategic asset allocation, which is really a mathematical kind of approach. For a certain amount of risk, you get a certain amount of return, and you just have to make sure those components are good, the best that they can be. And when I say components, the little slices of the pie charts. And I can only say that over the past 20 years, that's worked out well for us and for our clients. So we'll continue to be prepared for that, the good and the bad. We'll be, we'll be defensively optimistic. I love seeing good returns in portfolio, but I want some protections in place, and I want to make sure my clients' money is going to be there when you need it. And last week we talked about the 3 pillars of investing for us. That's asset allocation, principal protection, and account segmentation. So I'm not going to go into that again. But when I talk to you about these things that these analysts are saying, I don't want you to be concerned about it. I just want you to be informed by it, because that's exactly what it does for us. It informs our decisions. You shouldn't necessarily be concerned about your investments, because they should be built to withstand the fluctuations that could potentially come at us. And that's really where we stand with those foundations. And you've heard me talk about the foundations. I compare them to, the buildings in San Francisco and how they're built on, with the idea that from time to time there's going to be earthquakes. They're going to be cracked and broken a little bit, but they're not going to fall. So that's the analogy I like for our portfolio construction. So here I'm going to share my whiteboard with you. So let me just get back to my share feature. We had a couple people pop on here in the past couple minutes. Welcome for you that joined a little late. And we're going to talk about a place to put my keyboard, but we're going to talk about the 3 buckets. Now, you hear a lot about bucketing, and sometimes I use the account segmentation to talk about how to fund your retirement. Other people use this bucket planning, but our buckets are, you should all know this, how do we get green, where your investments lie. So everybody's investments lives in one of these 3 buckets. You've heard me say you really can't trick us. There's no special extra bucket or anything like that. It's going to fall into the taxable bucket, the tax deferred bucket, or the tax-free bucket. And again, I know this is review for most of you. This is also called tax advantaged. I got all that on there. How you like that? So let's define them first of all. So the taxable bucket are typically your CDs, your mutual funds, your stocks, your bonds. That's anything that sits in your bank accounts, your traditional brokerage accounts that are not tax deferred, right? No retirement accounts, nothing like that. But what is special about them is every year you get a 1099 from these agencies, whether they're an investment firm or whether you're a bank, and you get it for interest. You get it for capital gains, whether they're long-term capital gains or short-term capital gains, and you also get it for dividends. Let's shift it a bit. Sorry. And I think I covered all the areas there. So interest, capital gains, long-term capital gains, short-term capital gains, and dividends. Every year you get these 1099s from your institution, and you have to do what with the money that's reported on the 1099, and that is pay tax on it. So a big topic of conversation today is capital gains, but you're either going to pay ordinary income tax or capital gains preferable tax on these distributions that come out of the taxable accounts. Now, tax deferred, this is typically your traditional IRAs, your 401ks, 403B plans, 457 plans, anything that today you don't pay tax on, but the promise is you'll pay tax later. Now, SEP IRAs, etc. So the deal is, again, that you don't pay tax now when you make the contribution, or you get a tax deduction for making that contribution, but you pay tax later. And then how about this one, the tax-free? Well, there are really only two things that are truly tax-free, and that's anything Roth 401k, Roth IRA, and properly structured cash value of life insurance. It's very important that it has to be properly structured because not all life insurance is tax-free. And for something to be truly tax-free, it has to be free from all types of tax, right? So no federal tax, no state tax, no capital gains, and does not cause your Social Security to be taxed. No social tax. That's not a thing. Let's hope that doesn't become a thing. Social Security tax. So none of these. So can't trigger any of those for it to be truly tax-free. So the question is, how do you structure that? And there is a mathematically ideal amount for each one of these categories. Now, most people come to us with something like this. They might have, let's just say, $350,000 sitting in this taxable account. They've got some savings in mutual funds and at Vanguard or Fidelity or what have you. Sometimes it's much, much more, but I'm just giving you an example. And then they may have $1.5 million in various of these sitting in the tax deferred. For the math that I did, I'm going to make this $1 million just for an example. And often they have zero or very little in the tax-free, and certainly not as much as they like. So the question is, how do you determine where your investment should lie in these buckets? Well, we know, and we agree with most of the experts out there, that in this taxable bucket, we should have no more than 6 months to 1 year worth of expenses, not income, but expenses. Because hopefully your income and your expenses are much, much different. And hopefully your expenses aren't greater than your income, but they're much lower than your income. So I don't need 6 months to a year of income in there. I need 6 months to a year of expenses in there. And some people say 6 months. I'm okay with a year. I'm a 1 year person. I feel more comfortable with that. I think it's fine if you do too, but 6 months is manageable. The thing is, we don't want money built up in here that's going to constantly generate 1099s and build up that tax that you have to pay, whether you want it or not. That's really the key here, is structuring your investments and your money in buckets where you have control over what you're going to pay. Because here's the thing, we know that at $1 million today, let's just say, for an average person who comes to us is, 61 to 65 years old, or just entering or just planning to enter retirement. In this case, let's just use 60. Let's change that to 60. This is enough to deal with the $1 million that's in this tax deferred bucket, because at some point you have to pay tax at some point in the future. And the issue is that we don't know what that tax rate's going to be. Remember, you have a partnership with the IRS, and the IRS tells you exactly how much of that business partnership they own in your retirement, and you really have no say. So right now we know what it is because we know the tax code, but we don't know what that's going to be in 10 years or so, right? And we also have no control over it, because if you're 60 today, the way the law is today, at age 72, you have to take out RMDs, required minimum distributions. The IRS tells you exactly how much you're supposed to take out of your IRAs every year. And if you don't, you're penalized 50%, 50% of what you should have taken out. Well, that's an enormous penalty, and nobody wants to have to cover that. So if you had just a 6% growth over those 12 years from 60 to 72, just at 6%, well, you would end up with about $1.9 million in your IRA. And that would equal approximately a $75,000 required minimum distribution. Now, I see a question. I'll get to you in a moment. Now, you may want to take that money out, and you may not want to take that money out, or you may not want to take that money out, but you have to take it. And again, what is the tax rate? So let me just check this, because I want to make sure you're all seeing my screen. Okay. Gerard, I'll get to that question. All right. So you may not want to take that money out, and you have to pay tax with whatever that tax rate is going to be in the future. And we don't know what it's going to be. You and I all believe that it's going to likely be higher. So the issue is that we want to get these funds from tax deferred to tax free. How do we do that? Well, there's a couple different ways. Number one is you could do Roth contributions. So there are limitations to what you can contribute, and you must have earned income. There are the second option is Roth conversions. Now, with Roth conversions, there are no income limitations. You can convert as much or as little as you like in any given year. The toll is tax. To do the Roth conversions, you have to pay tax. And in fact, with Roth contributions, you have to pay tax in the year that you make the contribution. So they're both really valid ways to get money into here. There are some, again, limitations on income for Roth contributions. You can only make so much money before you start getting phased out. And there's a limitation on how much you can contribute. Now, if you have a Roth 401k at work, there are no income limitations, and you can contribute a generous amount and even more if you're over age 50. But we're going to today talk about Roth conversions, because ideally we want to get this money here, let's start using green, this money here over to here. But I tell you, there's a mathematically ideal amount, because not everybody has to convert the full $1 million. I want you to remember this. If you don't have pension, if you don't have rental income or something that's going to be generating money, I work with a few people who have a lot of their money in TIAA-CREF, and TIAA-CREF is really, really good at holding on to your money for really almost the rest of your life, certainly for a good chunk of it. So many of folks in TIAA-CREF can only take a certain amount every year out, and that's troublesome, because it continually generates income for them, tax deferred income. And again, we're dealing with this I don't know tax rate. But if you don't have constant income that you can't control, and that's going to be forever taxed, as my mentor Ed Slott likes to say, then you may be able to leave a portion in your IRA that you're never going to pay tax on. So you've got to determine what amount that is, And how do we do that? Well, there is a mathematical equation, just like anything else, and it's different for everybody. I'm going to show you an example, but it's different for everybody. Let's say that you've got let's say this is a husband and wife, and there's a combined Social Security of $43,000 a year. Remember, to be truly tax-free with an investment, we also don't want Social Security to be taxed. Social Security is taxed using a structure that we call provisional income. And provisional income is the income the IRS tracks to determine how much of your Social Security is going to be taxed. And currently, it looks like this. For married filing joint couple, from $0 to $32,000 a year, well, you don't pay any tax on your Social Security. From $32,000 to $44,000 a year, that looks like $441, but it's not. $44,000 a year, you pay up to 50% tax on your Social Security. Excuse me. Let me rewind that. You pay up to 50% of your Social Security will be subject to your marginal income tax rate. It is not 50% tax on your Social Security. It is 50% of your Social Security benefit will be subject to your marginal tax rate. Now, anything over $44,000 for a married couple, up to 85% of your Social Security benefit is subject to your tax. So it's great if you could keep all taxable income. This is taxable income. It's actually based on modified adjusted gross income. If you keep that below 32,000. For a single filer, it is, let's see, 0 to 25,000 is 0%. 25,000 to 32,000 equals 50% of your benefit is subject to tax. And then anything greater than 32,000, that gets you to 85%. So why is that important? Well, because ideally you want to have your Social Security benefit also be tax-free. So this is where the balance comes in with this factor here. So how do we determine how much needs to go from this bucket to this bucket? Well, why not convert the whole thing? As I said, you might be able to leave a certain amount in there that is going to never be subject to income tax. So when I first started doing the classes, maybe a year or so into it, I had a fellow who came in and he said, "Mark, I really understand this idea of moving things into Roth IRAs." And in fact, I was talking to my life insurance agent, and he said that it's a great idea and you should convert everything. And I said, "Well, that's good. I'm glad he's got his head in the right place. How much did he think you should convert this year?" He said, "Oh, I think he thinks I should do all of it." Well, at the time we wrote it on a whiteboard, and I looked at it, and it was over $3 million in his IRA. And I thought, oh my goodness, that's going to be a huge tax bill. Why not spread it out over the next several years? Well, he hadn't thought about that. So that was a good thought. And the other thing was, well, do you have to convert all of it? And the answer for him was no. Now for you, it might be, yes, you have to convert all of it. But for him, it was no. Because let me explain this to you. Because if in fact, we're able to reduce, and in this example, I was able to leave $235,000 in this IRA. So after conversions, I left $235,000 in this example, $235,000 in this IRA. Now, this is not your number. This is this example's number. And it's your number is going to be different. It might be zero. It might be $500,000. I don't know. If we leave $235,000 in the IRA at age 72, that required minimum distribution, is $9,195 RMD, required minimum distribution. Now, what's interesting about that is everybody gets a standard deduction. So if we inflate the existing standard deduction amount, it probably will be somewhere about $36,000 in the next 12 years, or at the end of 12 years. Well, is $9,195 less than $36,000? The answer is yes. So isn't then $9,195 absent any other income that you want to use to offset the standard deduction. Let me explain what a standard deduction is. If you don't itemize your deductions, everybody at least gets a standard deduction. This is not the value today. This is the assumed value using inflation in 12 years. It could be higher, it could be lower. Again, this is an example. But isn't $9,195 less than $36,000? Yes. If this is your income, then won't that be offset by the standard deduction? Probably. We'll have to do all the math to figure it out, but probably because it's much lower. All right, I hope you're following me. I see a couple of questions popping up. Let me finish this example and I'll come back. So then we take the remainder and we can convert that remainder over to a Roth IRA. Well, what we end up with is about $1.25 million in a Roth IRA after conversions and after paying the tax. So you can pay the tax one of two ways. You can either withhold the tax because tax has to be paid. You withhold it from, we send it directly to the IRS during the conversion process, or you pay it out of this bucket. Because these folks aren't spending $350,000 a year, are they? In this case, they're not. Some people might, but they're not gonna have a successful plan anyway if they're spending $350,000 a year with the investments they have. But if they're spending, let's say $120,000 a year, they have too much money in here, right? So we can pay the tax out of this as we go, or we can withhold it, which means if we convert, say, $120,000 a year, we figure out how much tax we should withhold and we send it right to the IRS for the client, never to be seen again, but never having to be dealt with again. So let's just pull back for a second. So we've moved all but $235,000. We've kept up with this just 6%. I just didn't assume 6%. Of course, you could earn more than 6. You could earn 8, 12, 20. You could earn less. It depends on what you're invested in. I'm using the 6 as an example. You move that over, the remaining money over to the Roth IRA. Now, any distribution that you take, assuming you've met your 5-year requirement, that's a big conversation. We can have that another time. Any distribution that you take out of your Roth IRAs, you pay 0 tax on. This required minimum distribution, because we reduced it, is also 0 tax. You're not paying money on that distribution. Now, the problem is that you still have money in this bucket. I'm on the left over here, right? The taxable bucket. That's generating interest, even tax-free interest. Some people say, well, can't I just put it in municipal bonds? Well, that counts as provisional income. Provisional income has many things that count, including tax-free, tax-free interest in municipal bonds, your pensions, any distributions from your IRAs, including required minimum distributions, any income you have, any rental income, and 1/2 of your Social Security benefit, they add that back in. So it's really easy to hit these numbers here. But if you're careful and you reduce this down, I'm over here on the left again, and you reduce the middle bucket, your tax deferred bucket down, then you can be in a tax advantaged or a tax-free situation in retirement. But the problem is, let's just say you've got, a couple $100,000 here that you're not using. What do you do with it? Well, this goes to that cash value of life insurance. This is another tax-free or tax advantage bucket. You've got to figure out, let's see if I can find another color that's beneficial here. Let's make this teal. I like teal. You've got to figure out how much money can flow over to this cash value life insurance, which is the other tax-free bucket or tax advantage bucket. So you want, ideally, I'm not going to get into the details of the life insurance, but you want this to be able to grow. You want some growth mechanism in there with some level of protection or safety. You're going to have a death benefit here. Hopefully also have some kind of long-term care benefit. But if you're able to structure it correctly, that's why it has to be properly structured, then you should be able to draw some funds out of here in your lifetime. So after filling up this bucket, you want to be able to draw out money for this bucket to also pay for your retirement. So you want it to grow in the meantime, earn, anywhere from 5, 6, 7%, probably as much as maybe 10. It just depends on the platform. But you want to be able to draw money out during your retirement, probably after 10 or 11 years. Well, believe it or not, folks, any withdrawals out of that properly structured cash value life insurance is also zero tax. So let's add it up. If your IRA equals 0% tax, right? The required minimum distribution here. And then your Roth equals zero tax. Any distributions out of there are zero tax. And your cash value of life insurance, some people call these life insurance retirement plans. If that is also 0% tax, then your Social Security benefit would also be 0% tax. And that leaves you at a 0% tax rates. And if taxes double the way we know that they have to over the next 10 years, or maybe even less, then 0 times 2 is always 0. Now, if you get up to the next level and you're in a tax advantage situation, that's a good place too. But that's really the importance of this bucketing strategy when we're talking about where your money lies. And my daughter would say, Dad, that's not teal, that's light blue. Now I can't get it to change again. Oh, goodness gracious. All right, we're going back to black. But that's the importance of this bucketing strategy and having your money in the right place. Where are your funds and how are you going to best position them going forward? The investments are secondary. It's just as important. When I say secondary, it's another step. It's just as important, but we're not talking about how it's invested. We're talking about where it's invested at this point. Okay, so I see some questions. So let me pause there and I'll take the questions. I'm setting this back up. Gerard, how do you utilize the current historical periodic table of returns for weighting investment strategies? So that's a really complex question for most of the folks on this webinar. The Cowan historical periodic table tells us historically how different investments have performed over the years. And I base my structure of portfolio management on modern portfolio theory, which uses typically, it depends on what Cowan table you're looking at, but some of them have alternative investments, some of them don't. But let's say, how do I utilize it? I utilize it as a tool to look back to see how things are, or how things have been. But I don't use it to overweight or underweight. Related, and then Gerard asks, related to your current discussion, is there any talk in Congress not to double tax Roths, but to limit the amount of IRA convertible to Roth? There surely is discussion about, there used to be that you could only convert so much in a Roth IRA. I don't remember the details of it, but that was removed, I want to say 8 to 10 years ago. But yeah, you could only, there were limitations, and there is some press coverage about the fellow from PayPal who now has billions of dollars in his Roth IRA from a very risky investment in PayPal, when it was a private stock. So that's getting some momentum in the news. I'm not sure though that the average person is going to be able to have those kind of funds in a Roth IRA, but it would be troublesome if we were limited on Roth conversions. But here's why I don't think that's going to happen, because every dollar we convert sends good money to the IRS now. And the IRS is a now I'm hungry kind of vehicle. They don't think like we do. They're not long range planners. They think about what we have to fund now to be able to get to the next vote and maintain their power source, right? So that's really what that comes down to. I saw someone raise a hand. If you have a question, type it in the Q&A because I can't call on you with a live call in. So let's just see maybe who that was. Nope, I don't see any hands up now. Okay, well, folks, that is it for today. I hope that was helpful. I know that's kind of back to the basics. Many of you have seen this before. I'm sorry if I just shared everyone's names there. My apologies. I didn't realize I was still sharing that. So let me stop sharing my screen. I know that was back to the basics for many of you. You've seen that before in classes, but it's good to remind you, right? It's good to remind you why we do these things and the importance of those buckets. What we're striving for each one of you is to minimize those taxes as much as possible. Many of you get to the 0% tax rate, and that is really exciting. It's a lot of work. It takes a lot of adjustment each and every year. There's only so many hours in the day to do it, and I don't know how individuals do it on their own, but we've gotten quite good at it over the years, and I'm proud of that. So I look forward to seeing you in 2 Tuesdays, not next Tuesday. I'm on vacation, but the following Tuesday we'll be back, and we'll have further webinars. And if there's no other questions, we'll see you then. Thanks, and have a great week. Take care. Hello again. I hope you enjoyed the video, and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.